Cool. So, this video, I just muted myself, but, cool. This video, won't be too long. Um, I'm guessing what I'll do with this video is, just go over, one of the ways that I am able to identify institutional sponsorship, and of course, within that, be able to identify, order flow as well. Uh, all I honestly do is just use the concept slash theory of time and price. Uh, and I honestly don't do anything outside of that besides study PO3, um, candle openings and closures as well, including the wicks, even though they don't really matter too much. But if you know, you know. The true volume is, of course, in the bodies. So, pretty much what I'm doing here is just outlining out the daily ranges here. Uh, it's pretty much called IPDA. Those of you that have been trading ICT concepts, that is who I learned how to do majority of the things that I do when it comes to my charts from. You do understand that IPDA is the interbank price delivery algorithm, and in short of simpler words, it's literally just the understanding of the delivery of price. Uh, so I'm gonna go over just a little bit of the range for the week because I don't want to make this video too long. Again, these concepts they can take up a lot of your time, so hopefully I'm able to sum this up for what it was that I was looking for. Um, and in the study of this, hopefully you can understand what it was that I was doing to pretty much, pass my evals within 4 days. Just looking for very similar setups within price action, and just understanding where we're at when it comes to the highs and lows within these delineated price levels here. It does make the understanding of where we are more than likely or possibly derived to go to on the higher time frame, and those signs will be shown on the lower, of course, since I'm utilizing the concept of time and price. um, when you look at time in between the frame of midnight to midnight, honestly, or midnight to market close, that is really that injection of liquidity that you are studying for the particular trading day. Uh, so everything that I'm doing here is pretty much calibrated to New York time. That's another important thing as well. Um, one of the key takeaways that you would have for this is, of course, making sure that New York time is calibrated on your charts. So that way you understand pretty much that New York sets the day, and when the algorithm comes online at midnight in New York, that's when you start looking, primarily within London session, Asia. Honestly, it's not really too much of a big ordeal looking at Asia session, but it is still good to mark up Asia sessions range starting back as early as 1800 GMT, which is 6 p.m. So that's pretty much, market open to midnight Asia range. From midnight um, up to the latest of 5 in the morning, that would be London sessions kill zone. And then between the time frame of what going on, 7 and up, going to that 9:30 opening, since this is an index. It's pretty much New York's, tradable session hours. So I honestly look at New York session between the time frame of 9:30 to no later than noon. Um, at earliest 11 o'clock. That is pretty much my trading range. So, if I can find my ideal setup to form within that 9:30 to 11 o'clock window, there's pretty much really nothing that I can do. At that point, I'll just be sitting at the charts and just staring all day, just waiting for the move to happen. So this is the weekly range, the individual 5 days of last week's price action: Monday, Tuesday, Wednesday, Thursday, and Friday. So it's very simple. All I am simply doing is delineating the days, the trading days, and marking the session highs and lows in between these ranges. It is a lot more complex than this, but this is as simple as I could possibly make it to a beginner, um, inside looking in, well, outside looking in. Sorry. So the very first thing that we'll see for the day, after you delineate it from Monday to Tuesday, you will pretty much see that we made the low of the day pretty much in London session. So this low was made at 2 in the morning. That was the low. And you see how prices rallied. We go up, all the way until we get up here, 11 o'clock in the morning. We peak here, making the high of the trading day for Monday. You see how 9:30, price pretty much shot up, came all the way back down, went all the way back up, peaked, dropped back off. We go up again and we close. But the closure happens all the way back here. Where we at? This would be 1800 GMT is 6:05. So on this 5 p.m. candle here, that's pretty much market closing. So the market closes here, and then we have the next trading day, Asia session low here. We swing higher, drop lower, create the low of the day. For Tuesday, same thing again. Tuesday, we end up making the low again within London session, and we swing back up again, going higher to the earlier stages of New York, 9:30 opening. We shoot higher, and we peak all the way up here for the session day, 1800 GMT. That'd be 6 p.m. And then we go ahead 5. So the market peaked its high here, and we closed off of this candle. Then go into the next trading session day, Wednesday, we end up making that low here. So before I go off and drag off too far, pretty much, what it is, trying to make it very simple, is notice how when the market sets itself up for a bullish bias, how London's low, within that kill zone of midnight to about 5 p.m. And even in between that range of that, you see how the low of the day on a bullish day is formed within London. So moral of the story, if London session between the time frame of about 2 to 5, this window of time is setting the high or the low of the day, relative to the trend's direction. In this case, the weekly range, the daily bias for these past 2 days here that I'm going over, which is Monday and Tuesday, London has set the tone for the rest of the trading day, which is good in the sense, because now that you understand what London is possibly doing for the day, it gives you a better idea of what you could possibly be doing in New York session. So in my eyes, think of it like this: when you Asia, it's pretty much like 25% chance that you right on the bias. There's not really too much information there besides what you have to rely on from the session that Asia previously is trading in or out of, which in this case it's Monday. Friday's trading range is pretty much what you would be looking at, or the last 2 previous trading ranges, before we go into midnight, starting the actual Monday. And then we go into London, and then now you start seeing a smooth injection of liquidity coming in, but you really don't get the full development of the trading range until, London, of course, but also as well that overlap into New York session, tying into that 9:30 opening. And that's when you start seeing the market, make all of its big moves, especially for these indexes, because that 9:30 opening is the opening of the stock exchange market. So you always want to trade, with volume, with volatility. Never want to be, trading within a dead market, because of course, trading in a dead market means what? Consolidation, um, unbiased price deliveries. At that point, you're just doing whatever the fuck just to make money. And the whole purpose of this is not just to make money, but to understand exactly how we are making that money to get to these derived targets, and have trust in the analysis to be able to hold until price does get to these targets. Though, there will be times where you might get in too soon, get in too early, and not be able to catch the whole trend or the whole move, or, a Tuesday low to Tuesday high type of, situation. But it does keep you in order flow. So Monday, Tuesday, these lows have been established within London session. We never came back down here to claim these lows, but the highs of the sessions have pretty much been bagged and tagged, and of course, price continues to deliver, up until the upside. Um, Being able to look at institutional sponsorship in this way, it does help you identify, pretty much where the what's the word I'm looking for? It helps you understand, high quality order blocks, within the trend direction that you're aiming for once you establish your bias. So in this case here, I didn't want to talk too much about order blocks and things of that sort. Just want people to understand exactly how you identify institutional sponsorship and be able to tie that into the targets that you're looking for the market to, actually draw itself into once you establish the bias for the day. So you can see, we have this bearish OB here that price ran through, didn't respect. And in that, this is pretty much like a bullish order block set up in a sense with Tuesday's price delivery, which in my eyes is, since I'm going over institutional, sponsorship, uh, being able to identify, order flow and looking for institutional sponsorship, it helps a lot so that you can get in sync, with the marketplace, because when you're looking at price exactly like this, it's very important to be able to blend, these two things to pretty much give us an indication of uh, what price is trying to do. You know, I know, most people probably don't believe in this shit, but price does work like an algorithm. It goes the areas that it's previously gone to before, and there are reoccurring patterns that happen every single time, every single day. It is your job to be able to study and find those things and be able to execute when you see those things happen again. So, too much talking, not enough time. So, we have a 1 hour order block here. I'll just call it 1 hour OB just to make it very short. Um, Now, I'm not just highlighting any type of order block. I am highlighting an order block after price has pretty much taken a short-term high here. Intraday, this was the high of Tuesday's trading session, all-time high. This short-term high was taken, and in the taking of this short-term high, we had the 930 impulsing and rallying above this high intraday, taking Monday's high as well. Of course, we have old highs resting back here as well from Friday's trading session, but we're just primarily focusing on this week. You can take these things that we're doing here and go back and study, the previous trading sessions highs as well, to get an understanding of where the market is seeking liquidity from. So this order block here is one of high quality. We have a short-term high taken. Um, Of course, 9:30 opening as well, which I'm gonna get down to the lower time frame and break it down. But we impulse at 9:30. Of course, you expect that 9:30 is going to impulse in either direction because there's a huge volume of liquidity coming into the marketplace at open, and this is where you start actually eyeing the market to look for that move in the trend's direction. So if you were already thinking, okay, on Tuesday, we're probably going to seek higher prices, there's resting liquidity above the highs of Tuesday and Monday, let's look to see if price is going to seek that liquidity resting above those highs. So we have a short-term high again, and then we have the highs back here from Monday. These highs back here have been taken off the 9:30 impulse, and then 2 hours later, 10 o'clock, 11 o'clock, the market ends up coming back down to correct itself and trade right back into this 1 hour OB. Um, the open on this candle was 25,640.25, and the low end of this wick was 25,639.25. So 640 and the low 629.25. So it traded about like 0.75 into that open. Um, Pretty much a prime example of how you want to see a candle wick out of a OB once it does trades into its opening range. So like this is probably like the best example I could show for like a perfect order block or a perfect ideal scenario for an order block. You do have an imbalance here as well between this high and this low, though I'm not really necessarily too much trying to tap into imbalances. I just want to showcase the study of the interbank price delivery algorithm. This is literally how I get a read on the highs and the lows of the day, and understanding where I'm at in between these highs and the lows of the day for the trading range gives me a great idea of where I am possibly going to take the market for targets, and gives me also a idea of where reversals and things of that sort can form as well, because these highs and these lows are pretty much PD arrays that are coming from the daily time frame. When you study price in this manner, you'll start to understand that no time frame is better than the other, because what we're studying is time and price. So these highs and these lows are always going to be important. They're always going to be derived from the higher time frame, no matter what time frame I go to. As long as I have price delineated like this, and I notate off the high and the low in between these delineated price levels, you go up to the daily chart, things of that sort, you'll literally see that these highs that are being marked off of these white lines here are the highs and the lows that's on the daily chart. So I will leave that for food for thought for you to study on your own and come to your own findings. So that order block was tapped into at 11 o'clock, and then price reacts off of that and shoots higher. That failed swing going lower now turns into a higher low in this sense, and price trades off of the reaction of Tuesday's high. So that's when you start, being able to tie in those concepts of support and resistance. This is how you get those concepts to work. Once you understand how to identify institutional, sponsorship within the marketplace, and of course, identifying where that order flow is now going to next, which is just the delivery of price. So this high back here on Tuesday, it now becomes void because we end up making the higher high here on the 10 o'clock candle, which is the next 4 hour PO3. Make this big, rotate this to the left, and I will drag it out. Cool. So that Tuesday's high now gravitates here. The market corrects itself, trades into that OB, and then we rally back up again and poke above Tuesday's high again, and then we go off into that closure, as I was saying before, at 5 p.m. for the trading day, and we pretty much closed bullishly on the day. So the market opened down here and we closed up here. That is a bullish trend direction. And then go into the study of this here, and how you would be able to form setups or ideas uh, once you identify, okay, where my bias is at. It's pretty much how important, you can use this. You can use this to establish your bias, and then of course now you trade into that direction. Once you see your confirmations, or whatever confluences that you are using to get to this derived target, which is Tuesday's high. So how do we get up here? So let's go down, and I'll just study this section. So that order block, this is that 930 candle opening. So what I would do is take the open, title it. So I like to fine tune, mark everything, anything that I see with my eyes, though they are, kind of fairly trained. I don't really need to see too much in relations to markings to know exactly, what's going on. So this is pretty some external range liquidity that we have resting here in the market. Takes that out. All the market literally does is trade externally, and in trading externally, well, let me rephrase it. The market trades internally to externally levels of ranges, because keep in mind, in order for price to gravitate into a different trading range, or to break structure in a sense, we have to leave a smaller range to branch off into a bigger range, and in us branching off into that bigger range, we end up trading out of another range. Hopefully that doesn't sound confusing, but pretty much this range here was internal, so we were pretty much trading within this zone here, and price left that zone to trade externally and reach higher, which is Monday's high, and then of course the new priced high that we made at 10 o'clock, which later becomes of importance because we traded back down. So in that movement of breaking this internal range high here, and then seeking external levels of liquidity, the market exhausted itself on the buy and came back down for a further correction. Now once you see this, you can start identifying, okay, I like to look for focal points in the trend, as in, where is my lower high that began the trend direction, and then where is my highest high from that swing point, just identifying your point A and your point B. So this low here, and of course up until this high here, you would pretty much be able to draw a Fibonacci. There is two ways that you could do this. You either take it from the low of the wick, from the swing point low of the wick up into the highest high within this range here. So I'll highlight it just so I'm not losing anybody on what particular range that I am looking at, which is pretty much the range in between this swing low here and then the high from Tuesday, and then drawing that out, and then I'll make it like a say like purple, I guess. That might be good. So that's pretty much the swing point that I'm looking at, and then the high. Just getting a feel of what it looks like. You see how the market make the correction and then traded off of this low and went higher, made this high, traded away from this high, and now we have our range. So now that I've identified that, you can go ahead and draw the fib and take that from the lowest body close. So this candle's open is at 25,624, and this candle's close is at 25,635.5. So 624, 635. So this candle here has the lowest close, and you draw that up until the high, These closures and openings on this bear candle and bullish candle are fairly similar, probably just slightly off. So the open on this bear candle is 25,753, and the open on this one is 25,772.25. So I would take the opening from the bear candle since it has the higher close. Well, it has the higher opening versus the close. It has the higher opening versus the open from the bullish candle. So now I'm doing that to be able to, pretty much identify my range. So I'm gonna lock it and extend the lines to the right, and we see how the market pretty much trades past the 50%, comes down into the 79, 88.6 correction within that retracement here, which is also in confluence with our 1 hour OB. You can use the Fibonacci in this sense to be able to identify other confluences within our already established setup. And then, furthermore, one more thing that you would need to happen here is, of course, a break of market structure, a retest. This is the 30-minute chart, so of course I wouldn't be gathering my entries from 30-minute chart, but I would be looking at the higher time frame to get an idea again of directional bias. So that's why this is important to study, because it helps you understand what the directional bias is to get in sync with it, and then of course be able to look for your confirmations to get into the trade once you're able to establish it. So let me take a curve, and pretty much we're saying, okay, from this OB here that has broken these highs and came back down into the range, we want to see price retrace, of course, to reestablish the imbalances that was made from the buy side being taken out. The market has created a big area of displacement, going to the top side. So we know that, of course, the market is seeking higher prices. It has showed us a huge distribution leg to the top side. If we come back down to correct, in a sense, you're not really necessarily looking for it to sell back off, but you're looking for the market to reprice and balance itself, create that liquidity in the marketplace, again, the delivery of price. And then we want to see the market, fulfill half of that range, 88.6% of it, and then seek higher prices again, informing newer higher highs. And of course, if we're going higher, where other place where people, reside with their stop losses is above these highs and these lows. So the whole idea of liquidity is for you to target these highs and these lows. So now we could go and study this same price leg on the 15-minute. So on the 15-minute, you can see the development of the range a whole lot better versus what you were seeing on the 30-minute. Here, you're able to fine tune that 15-minute imbalance. So we have that 15-minute imbalance being established here. The market trades down into it at 11 on that 11 o'clock open. Off that 11 o'clock open, which I'll notate that off as well for you, just so you can see how we trade under, come into that imbalance, trade into that fair value gap. Trading into this balance, trading into that 1 hour OB, price respects it, and we trade up. Now, after we have that rejection, that we're looking for, with the respect of our trade, next thing you're looking for is a break of market structure. So we have our break here, though if you're more comfortable, you could have got in a lot sooner, but I'm just trying to give the people that have the untrained eye a better idea of how you approach the market once you establish where the next delivery is pretty much going to be. So you don't have to get in down here when you have uncertainty. You wait for it to correct, and you look for the next break, and you get in sync with it. So I'll drop it down to the 3 minute. So you can see after price pretty much respected all of that. Let me fix this. We had that break here by 11:24, so I'm gonna say 11:25. That candle was pretty much broken. You look for your long here, and then of course your stop loss could be as low as here, but of course you want your stop to be within your respectable trade parameters. So I like for my trades to be at least within a 20 point stop, just due to the fact that I copy trade these express accounts on NQ, so I have to be a lot more careful. Excuse me. I have to be a lot more careful in terms of my entry, due to the fact that I have to be able to manage my risk accordingly once I'm able to identify my trade, which is pretty much why I don't try to get in too soon. If you catch my drift, I try to identify every possible scenario that could play out possibly before I get in. I want to be able to see all of my confirmations pretty much being hit, so that way I have a better chance of making money than losing money. And in the sense of just being patient and waiting, for those of you that do trade, you do understand that being patient and waiting for the trade to actually develop, it could reduce your risk a lot more significantly, because you're not trying to get in too soon or too early. So anything between about a 20 to 30 point stop, that's ideally how much I try to risk. But I don't want to risk anything more than about 20 points. A 20 point stop on NQ, if you do the math to that, you understand your risk management, you would know that 20 points of risk on NQ, with NQ being worth $20 per con, you simply just aiming for a 20 point stop and targeting Tuesday's highs, you would get a 1 to 3 out of this trade with a 20 point stop. You're pretty much risking $400. So at most, I try to risk $400 on a proper trade. And then for the targets, of course, they vary. So a 71 point target here just off of this trade ideal, even though you could have got in as early as down here, if you had the same type of idea that you were looking for and you wanted to see that idea play out. So we're risking $400 for a $1,400 target, which price did go ahead and shoot itself up there, which is cool to see when you're watching these things in real time, because everything that we're doing now is pretty much in hindsight. It's already happened, but these are the things that I am looking at and watching while it's happening in real time, so it's a lot different. So yes, price does exactly just this. It breaks structure, it gives you the entry, you get in, 20 point stop, and very clean delivery up into the upside. Barely any strong pullbacks or anything of that sort, besides what we had in this little consolidated price range that the market broke out of. So again, remember what I was saying about how price trades to internal and external levels of structure, and this happens on all time frames. So we leave this internal range and seek external prices heading higher. You have a couple of other identifiers here, such as your bearish order block here that we have on 3 minute. There we go. So we have our bearish order block here that we identify on a 3 minute. Though this is not an area where you're looking for the market to flip. This is just somewhere that you're looking for orders to pretty much be claimed. Yes, you can use these things as a target. Um, Honestly, I'm not gonna speak too much about this yet. Eventually, I get to it. But you got that order block there. You have the 3 minute imbalance. Price is trading within that 3 minute imbalance. It's respecting it. For those of you who like these type of scenarios, these would be called your IFVGs, your inverse fair value gaps. So we have an inverse fair value gap here. We have the 1125 high being broken, and we're looking for price to now go up. And that's the trade idea for the long, after all of the whipsawing and the back and forth playing from 9:30 going all the way up to this 1125 idea. So this is just food for thought, but you don't honestly have to literally, be in the marketplace. Sometimes it's best to just sit back and wait, and there are other, trade ideas that will form uh, besides the ones that you always, want. Everybody wants to get in at 9:30 sharp and bottom tick and top tick. It's not necessarily needed. What's needed is for you to make money. You feel me? That's what we need to be focused on. So, what is the best way to risk heavy, make money at the same time, and be able to significantly reduce your risk all at the same time? So, this is pretty much, what it is that I am doing, and still doing to this day. How I was able to, make the amount of money that I was able to make payout wise, trading these 50K accounts, just being very patient with the trades and just looking for my confluences to be, hit. So, in the studies of this, yes, this was Tuesday's high, but, you also have a turtle souping concept happening here, where we trade externally from the all-time high, and the market pretty much engulfed enveloped itself. I believe I said that right, but enveloped itself right back into the trading range that it left from, to come back down, and of course fill in those inefficiencies. Even when you're on the opposite side of the marketplace, there are still trades that are giving you opportunity to still make money. So, even if you didn't catch the in syncness with the long there, you had opportunity as well to, catch up short. 20-point stop. We got our turtle soup. The market is showing us willingness to want to go back down. We break structure, 20-point stop, and you're looking to pretty much target price into the 1 hour OB, that 15-minute fair value gap. Though I don't, necessarily consider this to be, a counter trend trade, though it is from the true direction. It's just another way to be able to get in sync with the market on what it's currently doing at that time. So, though, the market was bullish, you don't see any of this here, so you can't really account for that. All you would have seen at this time of day, from 10:25, 10:30, all the way to the last 30 minutes of that 30-minute candle, going into the 11 o'clock opening, was straight bearishness. So you have to keep that in mind, that there are still ways to catch trades with opportunities, if you just pay attention to what price is pretty much showing you. So hopefully this Tuesday scenario was like a perfect example of how to identify institutional sponsorship, and identify order flow as well, with the order blocks and the FEGs, and pretty much just waiting for that simplicity of the market to come down into your areas of that identify institutional sponsorship, and then you're looking for order flow to pretty much carry on forth with what it was doing once these targets and things of that sort are now hit. So this was beautiful, actually. So being able to see that play out and everything that you're looking for, give you the the setup that you're looking for. That's probably like a perfect case scenario of everything that you would be looking for within a order block play, and for price to pretty much create that low in that next um leg to be expanded into Tuesday's high that was up here. So that's cool. So now when you start looking at everything else, now that I've gave you a case scenario, um, that's pretty much the same concept that you would have coming into Wednesday, Thursday, and Friday. So you'll see Wednesday here how we make the high here for Wednesday at 12:30. Um, the relative equal highs resting above here within these 15 minutes. And price has not came back up to this high yet until the delivery that we had Friday. So looking at Wednesday's high, that is pretty much a untagged high. Price has not been up there for the past 2 days. Um, it will be three going on into Monday. Well, Sunday's opening, and of course tying into Monday, depending on how the market moves for this upcoming week. Which again, you don't relatively know if the market is going to go higher, but you have ideas based on the footnotes that you are leaving on the chart here, what is more likely to do. So hopefully that is explained in a way that is very understood. I do not know, if the market is going to continue to keep going higher or continue to keep going lower. All I can do is leave my footnotes on the charts, and then that gives me an idea of what it is that we are more likely to do. So Wednesday's high, pretty much being respected up here. The market has not came up here to claim that high, which is cool. uh, we had the market break itself down, trade lower, and same thing here. I'll leave this for you to study on where the market was pretty much going up to. I'll give you a hint. I'll take that away. Study that 9:30 opening here, the high that we are clearly drawn to, and then what it did for the rest of the trading session day. Again, peaking within that within that 11 to 12 o'clock window. You'll start to notice, once you're studying this, that the market forms the low of the day, on the bullish day, since that's what we're pretty much going over on these past 3 days that we're looking at. Monday, Tuesday, Wednesday, we're bullish. You'll see how the low is typically always made within London session, 4:15. Came back down here around 5:45, early stages of going into New York, but typically we form the low of the day in London. Price respects it. And then we have that overlapping scenario with New York session, giving us that 9:30 opening, and then we boost ourselves right up into these highs here, taking that buy side and then going even higher again and just drawing up bullishly for the rest of that daily range. And then the market ends up peaking and making the high of the trading range day, typically somewhere around the hours of 10 to noon, about 11 to 12 o'clock. Honestly, you can go back on your charts and study it, and you'll see it every single time. More than likely, we're making the high of the day no later than noon, really. So we end up peaking and making the high of the day around noon, and then going into the afternoon session, the market pretty much traded off. Break a market structure, boom. We have a reclaimed order block here, being mitigated. Price respecting that break, respecting that mitigated order block, and then price sends itself off lower and traveling all the way down into breaking the low of the day, which is a huge PD array for us into the downside. So we had that distribution and then that redistribution going into the downside and taking Wednesday's low. So that's very quick, simple. Everything else you could pretty much study. Thursday, same shit. The market open at midnight. We end up peaking and making the high of the trading session. In this sense, this was a bear day. Within London, 2:15, and then here about 8:30, we poke up, forming the high for Thursday. The market sells off. If you've watched my shorts, my reels, you'll see that this was the trade that I was trying to take on a Thursday that I wasn't able to get in sync with due to the fact that I wasn't able to catch the continuation due to the reasonings of me not letting the trade breathe. But again, I'm being very risky trading, with a $2,000 balance and pretty much trying to flip it. Moral of the story, you have to be very cautious about the trades that you do enter into when you have such small amounts of equity. Trying to build a buffer and things of that stuff first before I actually start holding trades out and things of that sort and sitting and draw down. I'm honestly just not trying to sit and draw down, but I still want to see price gravitate to my targets. If I'm able to secure a great position into the trade, it allows me to put my stop in profit. But at 9:30, this candle ends up opening here. And we break the low here. So you wait for the break of market structure. You sell. And of course, looking at it from the 3-minute chart, 5-minute, it's literally just continuous selling pressure, just retrace, dump, retrace, dump, retrace, dump, all the way down till we get the Thursday's low intraday, and then making the new priced in true low of the day at 10:03. So I won't go too much into that, but you can study this on the 1-minute chart, just so you can see where you would have been able to get in sync with the retracement. Unfortunately, due to the whipsawing back and forth, but the continuous flow going into the downside, I wasn't able to set my stop loss in profit to be able to keep catching the short. So I limit myself to 2 trades. I try to get in sync, stop me out. Try to get in sync again. Once it broke structure again, stop me out. That was it. There's nothing I could do there, and I just had to watch the trade go. And then Friday, same scenario. Thursday's high is made. We poke it at 9 o'clock. 9:30 we sell off. Failure to trade and take Thursday's low. But we're trading within this dealing range here. The market trades within the premium and seeking discount below, and we make the low here at 10 o'clock and price breaks higher. So all of these things are pretty much things that you can study on your own once you understand exactly what it is that you're looking for. I'm thinking about all of this here is just, resting sell side liquidity that the market is just gathering, and we're just waiting for that delivery of the true move after 9:30. So, do keep in mind that on Friday particularly could have been a tricky trade for people due to the fact that we had news being released, employment changes, unemployment rate, the average hour earnings, non-farm payroll, heavy news drivers. So sometimes it can, take you to those derived objectives that you're looking for the market to go to. But then in the same time, sometimes it can cause uncertainty in your trading because it leaves a lot of this whipsawing back and forth movement, huge ranges, the market going up 200 points and falling back down another 200, and then finally going up and getting in sync and shooting up 400 plus points. So there are moves within it, but again, you try to stay away from the uncertainty and you try to get more in line with certainty that the trade is gonna be in your favor and things of that sort. So Friday could have been a particularly real tricky day, but the market still did what it did. It played out for longs. We took Thursday's high. Um, and still, it left opportunity if you know exactly what you're looking for. So we had the low here being made at 9:30, being taken. I'm sorry if I'm quickly going through these things. I just don't want the video to be too long. But we had that turtle soup scenario again. This is how I'm looking at reversals in a sense. That's pretty much what this is. So the market pretty much traded under this low here. We had the condition of a reversal being met. False breakout. Market returns back into the range. And this high here that pretty much began the trend is what I would have been eyeing. We come and break that high while now we're drawing into Thursday's high. The market leaves a fair value gap here. We have closures of the bodies. It respects it. It seeks higher prices. Again, you also have that order block. So it's so many other things that you could be looking at to get in sync with institutional order flow. I hope I didn't leave anything out, but yeah. So that is pretty much the whole thing that I am doing to pretty much identify institutional sponsorship and tying that with the concepts that ICT teaches. I pretty much utilize a lot of his stuff, breaker blocks, propulsion blocks, mitigation blocks, order blocks. Once you understand the theory behind time and price, everything just pretty much becomes clear. In the things that you are looking for is, you're honestly looking for moral of the story. If you're bullish, you're honestly looking for price to trade lower and then continuously keep topping out the highs until it stops, gives out, changes direction. And if you're going lower, you're pretty much looking for price to continuously keep toppling out the lows until it stops and then goes higher. And usually in those movements of the trend flipping, changing direction, those are the stages of identified reversals into continuations, and of course retracements and then expansions into the opposite direction. So this is just some food for thought. Those of you who do study these ICT concepts, maybe there are some things on here that I was able to identify with my eyes that maybe you didn't see. So you could take these levels, apply it to your chart, and then use it to understand exactly what were some of those things that you possibly missed throughout the week. So that is all that I have for you guys today. I hope you enjoyed being able to see this. Video is about 53 minutes. So yes, I'm gonna end it here, and I'll see you guys next time.